There's regular term life insurance where you pay for 10 years, 20 years, 30 years. If you die in that time, you get paid out. If you don't, the policy runs its course. There's no asset to take and use, whatever. It simply ends.
So David is calling from Pittsburgh, Pennsylvania, and his central question is, what can I do with an overfunded whole life insurance policy? I know you've dove into some of the insurance as a retirement investment philosophy, at least in LinkedIn, as I've seen. So if you have an overfunded whole life insurance policy, and let's make the assumption, I don't think David tells us here, he doesn't have a need for life insurance. What are some things that you can do to use that as an asset in retirement?
Sure. So super quick background. There's regular term life insurance where you pay for 10 years, 20 years, 30 years. If you die in that time, you get paid out. If you don't, the policy runs its course. Nothing else exists. There's no asset to take and use, whatever. It simply ends. Permanent life insurance, such as whole life, is something there is an asset. You have it for your whole life, assuming you keep it in force and actually pay when you're supposed to. There will be a death benefit until you die, be it 80, 90, 100. But there also builds up cash value within the policy, which is an asset. You can take the cash out, you can borrow against it. So that's what he's talking about here. Overfunded simply means he has a whole life insurance policy where there's a lot of cash value built up inside of it. Question is, I don't particularly need life insurance. Let's assume he has enough other assets or doesn't have people who would be financially hardened if he were to pass. So that's objectively, I'm guessing him saying he doesn't need it. What do I do with it? Well, there's a few things. You can just outright surrender it, in effect, cancel the policy and walk away with whatever the cash value is, whether it's $10,000 or a few $100,000, I don't know, but you can walk away with that. Now, there could be tax implications. If you take out more than you paid in total, the difference will be taxed. So if he paid $100,000 in premiums throughout his whole life and there's $120,000 in cash value, he takes that all out, he pays tax on $20,000.
But if he's taking incremental amounts, it's coming out without tax until he gets his premiums back, or that $100,000, correct?
That's correct. In accounting speak, it's called FIFO, first in, first out. So it's assumed he's taken out his contributions first. Only after he's taken out $100,000, then are the subsequent withdrawals taxable to him. So that's one option. You do that, the life insurance is over. You no longer have that death benefit, but you can take away the cash value and leave and do what you want. Another is keep the policy, and then you can just sit on it, not do anything with it. The cash value will continue to probably grow. The death benefit's still going to be there till you die. That's another option. Or you can borrow against it. So you don't have to give up and fully surrender the policy to get money out of it. You can borrow against the $120,000 in this example, cash value you have, where the policy is basically collateral. You're in effect taking a personal loan from the insurance company. They're collateralizing that loan by the cash value of your policy. The interest rates are usually fairly favorable compared to like credit cards, at least. I mean, it's probably 5%, give or take, currently to borrow money against your life insurance policy. So why would you borrow? Well, A, if you want to keep the death benefit intact, but still kind of monetize and get use of it in the meantime, you can borrow against it. It can also be a good buffer, sequence of return buffer in technical retirement speak. So if you are entering retirement, and as we all know, if there's a few really down years at the beginning of retirement, it's not ideal to have to sell off positions from your portfolio when they're beaten up, especially early in retirement. So if you have non-correlated, quote unquote, buffer assets that can help you sort of ride out the roughness, you can help preserve your portfolio so you're not taking money out when it's down. Borrowing against a cash value life insurance policy could be a good way to do that. You take the cash out, you're not touching your investments to get your cash. Now, the other potential benefit of borrowing against life insurance is you generally don't have to repay it during your life. What happens is if there is still a loan outstanding when you die, that loan simply gets paid off by the death benefit proceeds. So if you have a $500,000 whole life policy death benefit, and you have $100,000 of loans outstanding, let's say, when you die, only $400,000 actually gets paid out to your heirs. $100,000 of it's carved out to pay off the loans you had outstanding. So with some good management and monitoring of these policies, they could be pretty utilitarian, useful tools to do a few different things for you.
Yeah, a lot of it depends too. In whole life, it doesn't, I don't think it runs into this as well as much as a, say, a variable life is. Internally, what's happening is individual, the cost of insurance is increasing every year. And I've had instances, not with whole life, but with other structures of permanent insurance where significant loans were taken out and the person had to either continue to fund the policy or re-begin putting premiums in to keep the policy afloat because of this ever increasing insurance cost, or it would implode is the not non-technical term, or the cash value X the loan would no longer support it and it would implode, which would create a big taxable event. So whole life, I don't think is much of a risk there as some others, but that's something to think about.
Yeah, whole life is much more stable, less variability. It's a universal life chassis that you're referring to. Regular universal, index universal, variable universal. The cost of insurance does increase as you age. There's more ways in which they can go wrong and backfire, especially if you have a lot of loans outstanding. The policies can implode and you're kind of stuck at that point.
Yeah, and then you have a big taxable event that you can't avoid.